All right, what's going on, everybody? Welcome back to the MIE Trading Podcast, the podcast where I share my knowledge on trading psychology, risk management, and everything else that you need to know to become a better trader. My name is Brendan Murphy, and today I'm going to be teaching you the 4 different ways you can invest in a bear market to make money, either short-term, medium-term, or long-term, based on your experience level. Now, before we get into the video, I just want to say, please subscribe to the channel, click on the little alarm bell so you never miss the latest ways that you can become a better trader. So if you go and search for how to make money in a bear market, you're probably going to find endless videos giving you different strategies, different methods, different ways of making money in a market. And pretty much all of them are going to fall under one of these 4 categories I'm going to share with you. And so this video is going to allow you to determine which method is best for you based on your individual risk tolerance, your skill level, and your time horizon. Okay, so let's kick things off with the easiest way to make money in a bear market, and that is with dollar cost averaging. So with dollar cost averaging, the risk of doing this is low to moderate, the payoff is also moderate, and the time horizon is long term. Now, what is dollar cost averaging? Dollar cost averaging is simply buying into an instrument, scaling in. You're buying small bits regularly over a period of time. And so what that allows you to do is get in at a better price. So for example, the price of something is $100. Instead of buying 10 shares straight away, if you buy 1 share 1 week, 1 share next week, 1 share next week, as it's dropping, your average entry price might drop to like $75 or $60. And then when it goes up, you're able to get an even bigger profit and reduce your risk at the same time. Because if you're going in with $1,000 at a price of $100 versus averaging that $1,000 at a price of $60, that's now an average of $40 lower price that you got in, and therefore reducing your risk because there is less room to move down. Now, the reason that this is easy is because there's very, very little thought involved. As long as you're calculating your risk properly and you know that, okay, this is probably, no, not probably, this is definitely the lowest that the market can go. And if I spread my purchases over this long, this is my average entry price. This is the most that I can possibly lose. If you've done that correctly, then you can just buy every single week, every single day, whatever your frequency is. You can just say, yep, I'm going to buy. I don't need to think about it. I don't need to look at the market because I know this is going to work. I've done the research up front. So it's very, very easy. There's little thought involved. And when you do this, you know, we always recover from bear markets, and then down the line, 1 year, 2 years, 3 years, 5 years, you're going to be making a lot of money from this. And that's why it is a long-term investment. And that's also why the risk is low to moderate, because as long as you've calculated it correctly, there's less surprises, there's less active involvement, there's less room for error with this. And so that is method number 1, dollar cost averaging. So let's move into now the moderate difficulty section. And we're going to kick that off with shorting the market. So the risk of shorting the market is moderate to high. The payoff is also moderate. However, it can also extend into large territory depending on how you play. And the time horizon is short term because we're in a bear market. Prices are dropping right now. So if you short the market right now, you're going to make money right now. And when you say it like that, it seems very, very simple. Market goes down, short the market, make money right now, easy money. Now, the reason I've put this into moderate rather than easy is because there is more active involvement required. You can't set and forget, because if you forget, at some point in the future, the market will recover and you will erase all of your gains. And then you will move into losing territory, and you will continue to lose until you pay attention and decide to set things straight. So that's why this is not as easy as dollar cost averaging. So with shorting the market, there's a few considerations we need to make. Number 1 is getting in at a good price. The higher the better, but you don't want to get in too early, because if you get in too early, it might just be a pullback of the upwards trend. So if you have a pullback and you think, okay, now we're in a bear market, it's time to short. Turns out you were too early because you were too eager to get that good price. Now you're starting to lose money because you were impatient and you just wanted all of that money. You need to wait to make sure that we're in a bear market. Do the research, make sure you know that the market is likely to continue going down, and do some risk management. Place a stop loss, do something so that if the market goes against you, you're not going to erase all of your account. And the reason that the payoff is moderate to large is because if you short the market, you're going to make money on the way down. Whereas with dollar cost averaging at the start, if the market keeps dropping, all of these positions are going to be losing until it turns around. So shorting allows you to make money on the way down. That's why the payoff is higher. Then we move into, this is the second method in moderate difficulty, although I think the difficulty of this is higher than simply shorting the market because it is a lot more, well, it's potentially a lot more complicated. And that is hedging the market. So with hedging the market, the risk is anywhere from low to extreme. And that's because it takes a lot of active involvement. However, the payoff for hedging the market can be extreme as well. The payoff is massive. And the time horizon for hedging the market is actually medium to long term, kind of short term, but not really. It's mostly medium to long term. So what is hedging the market? Hedging the market is either buying negatively correlated instruments to offset your risk in either direction, or both buying and selling the same instrument, again, to offset your risk in either direction. So what that means is, let's say you both buy 1 unit of some asset and you sell and you short 1 unit of one asset. So now the price of that asset increases $100. That long position has increased by $100 and that short position has decreased by $100. Now your net return off of this is zero. So you might say, why would you want to hedge the market? Now, number one, you don't lose. As long as you never sell both of those positions, you don't lose. The only thing you lose is the fees that you're paying to your broker for giving you the ability to hedge the market. Now, here's where the payoff comes in. And this is why this is more difficult than shorting the market. And this is why the risk can be extreme. So let's say market is, we're in a confirmed bear market. It's going to go down for another 6 months. For example, you both buy and short the market. You go long and you go short. Then, and theoretically, you can go as big as you want with these positions without losing, as long as you don't sell either position. This is not advised, by the way. Okay, so you've got these positions. Market drops 50%. That short position might be up $10,000 right now, and the long position down $10,000. So you hold both of them until you get to the bottom of the market. Then you close the short position. Now your balance has increased by $10,000, and now you have that long position in negative 10,000 territory. However, because you've timed it at the bottom, now the market starts going back up. Now, along with this, you could buy at the bottom. You know, that capital that you allocated to the short, now you could allocate it to the buy. Now you've dollar cost averaged as well. And this is becoming, if you do that, now you're into extreme difficulty territory. But even if you simply wait until price returns to baseline and then you close that long, now you've made money off of the short, theoretically very low risk. Or if you just wait until a new all-time high is formed and then you close that long that you had initially with that hedged position, that one's going to close in profit now. And so now you've made profit on the way down as well as on the way up, and you have also offsetted your risk thanks to hedging. Now, it sounds really simple. It sounds, okay, so if I buy and sell, I never lose. All I have to do is close the short at the bottom and then I make money. It's free, it's low risk, it's easy. The difficulty comes in the timing. It's so easy to say, just buy the bottom, just buy the bottom. Buy the bottom, it's easy. Just hedge and buy the bottom. It's not that easy. We can't predict the future. And if you ask anyone experienced in economics, they're never going to say, yes, I can predict the future. This is when the bottom is going to be. They're probably going to say, I don't know when the bottom is. Might be here, might be there. I would guess that this is likely around where the bottom is going to be, but they're never going to speak in absolutes. So that's where the risk comes in. If you do hedging poorly, let's say you close the short too early and you've only got the long open, market drops another 25%. Now that long position loses and you haven't got the short to reduce the risk. Or let's say you close the short too late. You hit the bottom, market starts going back up, the short gets back to break even, you close that, and now you've just wasted 6 months, 12 months of your time and you're still at $0. So you've just got paid negative dollars for your time, basically. You haven't even broken even because you've wasted time. And so if you do it wrong, you can lose money on the shorts and lose money on the longs. So it's very, very important to do it properly. And it's not something to just go, yes, I'm going to hedge. It's easy. But it is theoretically a very large payoff, and it can be safe if you do it properly. I think I've said that enough at this point. So then, now that we've covered the moderate to high difficulty options, let's look at the most difficult option. And that is simply going long at the bottom of the market, buying the bottom. And as you know, I've just said, it's not easy to buy the bottom. You can't know where the bottom is going to be for sure. So with going long, buying the bottom, the risk is high. There's no low to high. It's just high. The payoff is large because if you pick the bottom and you go all in, for example, you can double, triple, even quadruple your money. Hell, you could 10 times or 20 times your money if you have leverage. Not saying you should do that because again, risk is very high. And if you have leverage, you're multiplying your risk. And the time horizon for this is long term because number one, you got to wait for the bottom. 3 months, 6 months, 9 months, 12 months or longer. Then you've got to wait for it to get back to break even. And then you've got to to match the previous all-time high. And then you've got to wait for it to make new highs. And that's another 6 months, 12 months, 24, 36 months before you get that 100%, 200% payoff. So it is a long-term option for making money. The risk is high because, as I said, if you try to pick the bottom, you do it too early, now you're going to be losing on the way down and you're praying it doesn't go so low that you hit margin closeout and you lose all your money. So make sure you're managing your risk properly, that if you're wrong, you don't lose. That's a very big important lesson for all investors and all traders. Make sure you don't lose if you're wrong. And the reason that the payoff for going long at the bottom is bigger than dollar cost averaging is because theoretically, if you time the bottom and you go all in, now your average entry price is the lowest. If we compare it to the original example, instead of the average entry price being 60, maybe you get in at 40, and then percentage wise, that's a significant improvement. Yeah, those are the 4 options of making money in a bear market. Again, just to recap, the easiest option, dollar cost averaging, do your risk analysis, and then it's set and forget. Moderate difficulty, shorting the market. You have to pay attention continually to make sure that you're going to get out and that you're not holding it for too long. Slightly upping the difficulty, we've got hedging the market. It is potentially low risk, potentially high payoff, potentially extreme risk, potentially lose your money, depending how you play it. And then the most difficulty is timing it and going long at the bottom because you have no way to offset your risk in that situation. So one thing I want to say is that none of these options is the best. There's no such, don't listen to these and think, okay, so this has the highest payoff. Listening to it, you probably might make the takeaway of hedging is the best, because if I do it right, you might think, I'm not stupid. I'm going to do it right. I'm going to have the low risk and the massive payoff. There's no right option here, okay? It really matters. Your experience and your risk tolerance and your time horizon matters. There seems to be this desire for people in the investment and day trading community to say, I'm a risk taker. I am not scared of risk, and so I make money. And oftentimes I see this hurting people's accounts. Personally, if I lose 10% of my account, that's when alarm bells start going off and I start to get emotional in my trading. So I need to make sure I never lose more than 10%. And when I talk to my clients and I say, what's the most you are willing to lose? They often say numbers like 25%, 33%. Some say 50%. And then when we trade and they lose money, again, it seems to be the 10, 15% mark when they start to get emotional. So you need to be honest about your risk tolerance, because most people's risk tolerance is actually a lot lower than they claim. And that's because they want to say, I'm a risk taker. The other thing, none of this is financial advice, okay? You need to do your own due diligence. You need to do your risk tolerance. You need to talk to a professional and come up with something based on your personal situation, because none of this can take that into account. And with all of this, it comes down to you, okay? The market does not make you money. Shorting the market doesn't make you money. Going long doesn't make you money. You make you money. So if you work on yourself over a long term, that's going to pay off bigger than any single investment you can make. And if you want to be successful in the market, you need to be proactive rather than reactive. So this is another little side lesson. If you're reactive in the market, you're always going to be buying the top and selling the bottom, because you wait for it to drop. And if you react to that, you're going to say, okay, market's dropping, time to sell. You've just bought the bottom. Market's going up, up, up. Everyone's saying, yeah, I bought crypto. I bought this stock. I bought Tesla. Look how much money I've made. By the time it comes to you, if you're reacting to this, that's the top. That's when it's going to go down, and that's when you've bought. So you have to be proactive in buying at the bottom and selling at the top. It's a lot harder than it sounds. It's very easy to say, hard to do. So I think that's enough disclaimers in there. Thank you very, very much for watching the video. Hopefully you learned something about making money in the market. Please remember to hit the like button if you liked the video. Leave a comment on your thoughts, how you plan to manage your money in this market. Share it if you think someone else can find this valuable. And as always, please subscribe to the channel if you want to hear more tips like this. You can also go to my website, mie.trade, to work with me. We'll work on your personal trading improvement routine. That includes study, that includes weekly check-ins. You get my strategy optimization platform, one-on-one mentorship from me, and access to my indicator toolbox. Lots of cool stuff there. It's free to book a call and see if it's right to you, so no risk there. That's everything now. Thank you again for watching the video, and I'll see you again next week. Bye-bye.